from the point of view of, let's say you take the average investor, okay, and over a 20-year period, how would you guide that investor through that period in the way of finance to building a property portfolio?
Sure. Okay. Well, I guess we'd set up a strategy. So we'd say, okay, how many properties would you like, and what size properties would you like to purchase over that period? As you mentioned earlier, the beautiful thing about gearing is that you obviously gear up as much as possible, or generally as a savvy investor, you gear up around 80% of the property, and you'd only have to put in 20% equity or 20 plus another 5% to cover the stamp duties and fees. The property keeps growing, whereas generally the debt stays the same, so or reduces. So I guess we'd structure it in a way that if you say, okay, properties are doubling every 7 to 10 years, let's just say on average, then you can map it out over so many years and say, okay, well, by the time we get to this point over here, all you have to do is sell one property and they would have paid off all the debt and all these other ones, if that makes sense. So we can map that out for the client, but also you can start working out if there is if the equity is being built up over a certain period, you would know that you're going to have equity at this point and this point and this point to be able to reinvest in further properties.
Okay.
Now, the other good thing as well, as you mentioned, is that in addition to the equity growing, invariably, the rent should be growing as well. So what does that help? That helps obviously with the servicing capacity. And I've got a number of clients out there where, one for example who's got 9 properties on a reasonably, a standard income, but has built up 9 properties in their portfolio by essentially buying well and ensuring that the rent invariably covered the majority of the repayments. So they're only covering a very small smidgen, and if that small smidgen can be, broken down or reduced with depreciation and other benefits, then they can continue to grow for what it's worth.
I think there's something to be said about that as well. You mentioned that individual who has 9 properties. Usually, one of the things that we see, and it's a classic example of what tends to happen. You have 2 people who start from this base level here. One decides to become a property investor, the other one doesn't. And what you'll find is that, let's say they're both earning $50,000 a year. This one buys a property, this one doesn't. The amount of the income they have after tax, this person will be pouring into their property, struggling. This person will be going on holidays, buying cars that are going to depreciate. In the beginning, it seems like this person has the better deal than this one, and this person tends to struggle. But eventually what happens is, over time, what happens is this person eventually builds enough wealth in their portfolio to make their life more comfortable, while this person has to continue to keep working. And after a period of time, say 10, 20 years, this person is in a far better position than this one here and can really relax and take it easy. And like you said as well, once this person gets to this point here, they can then sell down a lot of their debt just by selling a property or 2, having an extra, say, 5 or 6 that may be paid off fully, having pure income coming in from the rent, and their life becomes exceptionally easy compared to this person here. And I think that's something to be said about property investing. In the beginning, it may be hard, but the people that I've seen that have literally built empires have in the beginning struggled. Along the way, there have been roadblocks and there have been things that have gotten in their way, but after 20, 30 years, they literally have empires. And that, I think, is one of the key things to property investing, is that when you get into it, to know that in the beginning it's not going to be easy, and there will be things that come along the way that will be problems, but in the end you can do quite well because of it, simply because of the compounding nature of property, and simply because of the ability to leverage and to take finance from the banks and really create this whole empire here.
Totally agree. I've heard it said to me once that it's not timing, it's not the timing of when you buy the property, it's the time in, and I think that's right.
Exactly.
The amount of clients that I've seen where they keep vacillating whether this is the right property and if it's perfect in every way, and I'm going to wait another few months and just get the right one, and 2 years later, 3 years later, I'm still waiting for the right one, and they might have a couple $100,000 sitting in a bank waiting to be invested. And guess what happens? If they just bought just the one that might have been 80% right or 90% right then, it would have seen them or held them in good stead over those next few years.
Well, this is the other thing to be said as well. You say, someone's got $100,000 in the bank. Someone's got $100,000 in the bank, and let's say the average house is $500,000 today. They can buy with a 20% deposit the $500,000 house. If they wait for 10 years, and like I said, they're vacillating, they're not making their mind up whether to buy or not.
Yes.
And now they've got $100,000 in the bank, and now the properties are worth $1 million. Well, then their money in the bank is essentially depreciated from the point of view of being able to buy a property, hasn't it?
That's right.
So really, it's being able to get in buy smart in the best possible way, give yourself the best chance of success, but do it as soon as possible. That's probably a key thing to property investing.
That's right. That's right. And like you say, if you put $100,000 into a term deposit, for example, you might earn a percentage of sorts. And yes, you're going to earn that percentage. You still earn a percentage if you put it into a property, for example. You still get, at the moment, 4.5%, whatever it is, as a yield. Yeah. But in addition to that, you also get the capital growth, right? And you also, and the truth is, people say, oh well, let's say on a $500,000 property, I might only be getting 4.5% yield on that. But guess what? You're not having to put in $500,000. You're only having to put in that $100,000 or $150,000.
Exactly.
The rest is all being geared by the lender.
Yep.
So this is the very powerful thing, as you mentioned, Angelo, that gearing is very useful, and people that have used it well, as you say,
yeah,
have built up empires. And I think it's a matter for us to provide good guidance to our clients, to make sure that it's structured well, and make sure that, as you say, they've got a plan over the next 10 years or whatever the case may be to really build up that empire.
Yep. And in addition to what you were saying as well, they only have to put in $150,000, but to also remember that the other $350,000 that they're paying interest on is tax deductible. So that's also another tax savings that they can make along the way. So there's a lot of different aspects to property investing that can really accelerate the wealth creation process. One is finance and the ability to leverage or gear. The other one is all the tax benefits you get as well. And also, in the end, as time passes, rents will also increase as well as your capital growth.
That's right. And I think, as I said earlier, I think it is really important for us not to work in isolation. We work very closely with the property advisors. We, as finance specialists, we don't pretend to understand everything about property. So we certainly would liaise with a property specialist like yourself, Angelo, and also liaise with the tax professionals, the likes of the accountants and the financial planners and others, and also all the other parties involved, the likes of conveyancers, etc. Because I think it's very important for the client to get the best advice from all the key professionals throughout the process.
Exactly.
The other thing I want to say is that there is a misnomer out there at the moment in the marketplace that it's all doom and gloom, and we're already concerned about what's happening with credit and with finance going forward. I think you'll find that Australia is in a great position. Mm-hmm. In a great position. Out of the 10 AA rated banks in the world, only 10, we have 4 of them. Now that's going to hold us in good stead over the coming period, but also it means that there is money to lend.
Yes.
That's the most important thing. Now, yes, credit has been a little tighter. Certainly has been tighter during the last 24 months or so. But I'm very confident that with the right client and with the right structure, we can generally get finance through. Probably not as easy as we had in the past, but certainly to a great percentage of what we did.
Yeah. Could I make an additional comment as well, David? The people that I know that have done exceptionally well in property have been the ones that have been able to, during those hard times, when interest rates were 19%, and things were really bad as well in the past, have been able to stick it through and even buy property during that time. And once they poked their head across the line, once things came good again, all of a sudden things were absolutely rosy and peachy for them. They stuck it through. There will always be cycles in the economy. Things will always be good, and then things will always be bad. If you can ride through those bad times, in the end, you're going to do so much better than the people that kind of just give up and stop.
No, agreed. And I think, I guess you've got to look at both sides of it. You can say, okay, well, interest rates might be higher, but because interest rates are higher, maybe there might be less buyers in the market, for example, or whatever the case. And so therefore it means that now might be a good time to buy. And I'm sure you could probably advise on that. So we work with those, and people might say, oh, credit's really tight at the moment. Well, guess what? When credit's really tight, it generally means that it's a lot tougher to sell the property. Hence, you can't sell it for the kind of prices that you have in the past. So it's a great time. So you might be able to get some great bargains out there.
Exactly.
And hence, we work with our clients to ensure that they can achieve those bargains. And I have to say, I've got a number of clients who have made big dollars because during the times when it was tough, when everyone else was sort of saying, no, this is all too hard, they went in there quite aggressively and said, well, no, we want to see what we can do during this period, and obviously snapped up some great bargains and held them in great stead for a period thereafter.
I think that there's one other thing to be added to that as well, and that's this. When credit is lean in the economy, what you tend to see is the prices of property tend to not go up as much. As soon as there's a big availability of credit, boom, they go up. Everything goes in cycle. Right now, we're in a lean part of the credit lending. Eventually, things will start to relax. There'll be more credit in the economy. If people go in and purchase now, when things are tough and property prices aren't really going up, as soon as there's a whole lot of credit in the economy, all of a sudden, boom, they go up. If you can purchase now, you're going to have a great opportunity, I think, to be able to capitalize on the capital growth that you're going to make in the future.
That's true.